It has certainly been an eventful week for the Canadian government, not to mention the economy. On Monday, we had the shock resignation of Finance Minister Chrystia Freeland and the appointment of Dominic LeBlanc in that role. And in the middle of that, the release of the fall economic statement. Joining us for more on all of this is Derek Burleton, Deputy Chief Economist at TD. Never boring, is it?
No, it's been a ride.
I know, it's been a ride, and it keeps on, the roller coaster keeps going. I'd like to spend, I've got a couple of segments with you. The first one to talk about the economic update, and the second part where we can talk about just the outlook for Canada. But now that you've had some time to digest, and I know you've written a great piece on what came out, what stood out for you in this statement?
Yeah, I think one of the big things is that the fiscal plan didn't change all that much. I know all the eyes went on the $62 billion deficit number for the last fiscal year, not the current year, 23-24, which is about 2.1% of GDP. But that was largely, it wasn't due to just a lot of so-called wasteful spending. It was due to contingent liabilities, write-downs related to Indigenous. So these are items I don't think the federal government could have forecast or even speculated on early. So that number was a bit inflated. When you look ahead, the deficits didn't change that much. I think the current year's $8 billion higher, and then it converges on their 2024 budget plan. I think it's one of the, it's both sides of the equation. On the one hand, the government was out yesterday continuing to boast that Canada's fiscal standing remains strong.
Compared to others?
Absolutely, compared to the U.S., other international countries, low net debt to GDP. That very much is the same story. At the same time, this goes to Freeland's scathing letter to Mr. Trudeau saying they should have had more dry powder. Let's get rid of the gimmicks. Interesting thing, the gimmicks in part of their fiscal plan was only a small share. That was for the HST, the GST, a holiday. But, the interesting thing is that a lot of the spending was actually a good thing. Mm-hmm. So I think that was certainly something we've been pounding the drum on, accelerated depreciation. So very much more of a business-led. But the dry powder I come back to, and I'll just conclude on, they could have had more dry powder. So it's a government that has been spending. If they had kept spending just at sort of inflation plus population growth since they took office, they'd be in a whole lot better fiscal position. Spending's been averaging 6-7% on a pretty consistent basis. It spiked during the pandemic. So that's my big thing. We have a lot of challenges. Yes, some of the spending yesterday, I think, was the right spending. There's a bit of shift on that, but we could have had a lot more flexibility to address a lot of challenges that we face as a country going forward.
I want to just in a couple minutes. I'm going to put all the political stuff aside because that caught all the headlines But when you go back to the spending and the pro-business, pro-investment spending, those were still very positive to see those. Yes.
Yeah, I think when you look at $21 billion, I think in new spend over 5 years, which is, by the way, typical for a Liberal fall update. It's about $20 billion. They kind of stuck to that mark. It's about $4 or $5 billion per year over 5 years. Not a huge share as the economy, but what I did like is that 17 of that was really reflected one major item, and that's extending, because they have this measure, accelerated write-downs that businesses could take advantage of. That was going to expire over time, and that would have led to a big increase in the effective tax rate on investment. Yeah. And we had been saying they got to, at the minimum, extend this. It's not going to be a panacea for our investment outlook, but certainly would help to offset the low Canadian dollar, some of the impacts on investment from that. And they did that. So I was pleasantly surprised. That was known on the weekend ahead of the update. But good news. Now the question is, will it be implemented? We don't know, because we're not sure. Parliament right now, even beyond the near-term political drama, is kind of ground to a halt, not legislation. So there's still a lot of uncertainty as to what actually sees the light of day from any of this.
I want to shift gears, and I'm going to ask you, we don't know if this update is going to come into play. We actually don't know what the government that's going to be in play in Canada a little later on. We can predict or try and predict. But I'm curious for you, when you look at 2025 for Canada just overall, what do you see? And I'm going to preface this by saying, in your report, in my hand, well highlighted, it says 2025 will likely be a year of change for Canada.
Well, hopefully positive change, but we know there's some looming threats on the horizon. But, I've been comforted at recent data. It's been a tough 2 years in particular since the pandemic recovery for Canada. Not grown a whole lot. We've seen declines in economic activity in per capita terms given the inflation surge. But now as we end 2024, there's signs of a little bit of a pulse showing in inactivity and consumer spending. Consumers have been ramping things up a bit. We look at a lot of different sources, including TD internal data, to kind of measure that. And the spending numbers have been firming, which does suggest some positive impact from lower rates. Canada, has been cutting rates, Bank of Canada, more than any other central bank. And it's a very interest rate sensitive economy, given high household debt levels. And some of that may be starting to kick in. So am I
feel
expecting...
like there's a but coming.
There is. I'm an economist. I talk with two hands. But there you go. But the thing is that we still can't lose sight of the fact that it's not like household debt has been erased or removed. We didn't go through a recession where often you have a new point of departure. Still have some of the lingering headwinds, and those rates will take some time to kind of work their way through. I mean, consider that mortgage renewals are still happening at higher rates.
Yep.
I think, so it takes a while for lower rates to work their way through. Good news is we still expect a decent step up in growth. We're looking at somewhere around 1.7%, up from 1% in 2024. Still a little bit shy of trend, but better. And I think, hopefully, that we'll see that continue to firm through the first half of next year.
You're going to make me be the negative person, which is fine. I'm happy to do it here. But then you've got population, immigration, of course, we brought those numbers down. We've got, tariffs perhaps on the horizon. And those are big headwinds.
They are, and you mentioned the population. That is, that has been a source of growth for Canada in recent years. So
and stress.
And stress as well. It's put stress on infrastructure. It's led to higher rents. There have definitely been some negative consequences when we went from kind of 0 to 60. I'll use that kind of loosely in terms of immigration policy over a few years. Now we are moving the other way. In fact, data we just had out this week suggests population growth has slowed from a peak of 3.3. It's now down to just over 2% year over year.
That's big.
So it's happening quickly with some of the federal tightening in policy and immigration policy. The question we often get is, what's going to be the impact on the economy in 2025 from that? And it will limit the extent of this improvement, along with the lagged of rates and some of the other headwinds. But I'm not too worried that it's going to give the economy a real negative jolt, in part because we see more spending per household. So you're going to get fewer growth in households, less growth. You will see more spending per household as low rates begin to free up. There's good household net worth starting the year, and some of these engines will kick in. And some of the pressures, as mentioned, on rents, we're likely to see rent growth begin to slow, and that'll free up some disposable income for Canadians. So I don't think it's going to really thwart it. In terms of the labor market, the population growth will certainly stress some businesses have been relying on, importing cheap labor, but at the same time may get a bit of added investment. They may have to automate a little quicker. So a lot of cross currents there. And then, of course, the tariffs. What do you say about that? It's the real risk. We don't really know if it's going to happen or not in terms of 25% tariffs. I'm heartened from some of the fiscal update measures. One thing I haven't had a chance to talk about was some of the investments in border, drones and the like. This is something that the president-elect is looking for that may reduce the risk.
One hopes, yes.
One hopes some
NATO,
of the some of the more aggressive trade taxes against China in terms of Canada imposing tariffs on EVs and the like hopefully will help. That's what the U.S. is looking for. We don't build into that 1.7 growth outlook 25% tariffs, because if you did, you wouldn't have any growth at all and you might have a recession. But so we're hoping that Canada, eludes it. There may be some targeted tariffs, but I think the economy should be able to withstand it, hopefully.
What is your outlook for the loonie? We're hovering right at 70 cents right now. I guess it kind of depends on all the things you just said.
It does quite a bit. I think on our baseline, where you don't get 25% tariffs across the board on Canada, if you did, that loonie say goodbye. I mean, it's low now. We're starting the year around 70 US cents. We recently marked down our baseline under the no 25% tariff baseline assumption to 68, 69 US cents. It's going to dip into the high 60s. Shouldn't be much weaker than that, but it'll be weak. It's going to be at the low end, certainly break through the low end of its recent longer term range. So it's still going to be expensive to go to the U.S. Benefit, I guess, investors in U.S. dollar assets. But the big driver is a big rate differential between Canada and the United States. And that's going to be sustained through much of next year.